Welcome to the deep dive. We've got quite a stack of source material here today.
We certainly do. Excerpts from this proposed legislation people are calling the One Big Beautiful Bill.
Right. And our mission really is to help you, our listener, cut through what looks like some pretty dense legislative language.
Yeah, exactly. We want to act as guides, sort of pull out the key bits based only on what's written in these pages we have.
No outside commentary, just what the text says. We're aiming to give you a clear, neutral overview.
That's the plan. Understand what's actually in these excerpts. We'll be touching on potential impacts the sources describe across, well, a lot of areas.
Like taxes, healthcare, safety nets.
Business, investment, border security, energy, even some completely new ideas proposed in here.
So think of us as, I guess, neutral navigators for this material.
Perfect way to put it. We'll highlight the specific provisions, definitions, any limitations mentioned, effective dates, all straight from the document itself.
Okay, so let's dive in. We're going deep into the specifics found right here in this stack. It really does cover a lot, affecting finances, maybe safety net programs, economic incentives.
Border stuff, energy policy, it's broad.
It really is. So we'll take it section by section, pull out the details just as they appear in the text here.
Giving you that clear factual picture, straight from the source.
All right, where should we start? Let's maybe begin with something that affects pretty much everyone. Your pocketbook.
Good place to start. Taxes and some new financial tools outlined in these sources.
This first chunk of the sources seems to detail quite a few provisions that could, hit your personal finances.
That's right. It covers changes to existing tax rules, but also introduces some entirely new deductions and savings ideas.
Okay, so first up, changes affecting individual taxes. The sources mentioned several times that existing limits on deductions, or even some exclusions from income, are being extended, or sometimes terminated altogether.
Yeah, that seems to be a bit of a theme in this part, tightening things up or getting rid of certain specific tax benefits some people might be using now.
For example, what specifically do the sources mention?
Well, the text explicitly points to an extension of the limit on deducting qualified residence interest. That's, mortgage interest for most people.
Okay, extending that limit. What else?
It also details extending the limit on the casualty loss deduction. And looking at things being ended, the text mentions terminating miscellaneous itemized deductions.
Miscellaneous itemized. So things like unreimbursed employee expenses, tax prep fees, that sort of thing, those would go.
Based on the termination mentioned in the source, yes. It also specifies terminating the qualified bicycle commuting reimbursement exclusion.
Ah, so if you were getting that benefit for biking to work, the sources say that's gone.
Precisely. And there's more. An extension of the limitation on excluding or deducting moving expenses.
Okay.
And for folks who track this, an extension of the limitation on wagering losses.
So, taken together, it sounds like the sources indicate a move to clamp down on several specific itemized deductions and exclusions.
That seems to be the picture painted by these points in the text, yes. Reducing the availability of those specific benefits.
All right, so that's tightening existing rules. Are there any maybe new exceptions or opportunities mentioned? I think the sources mentioned something about business meals.
Yes, that's right. While there's generally a denial for deducting business meals, the text adds a specific exception.
An exception. So under certain conditions, they could still be deductible.
Potentially, yes. The source lays out the specific conditions for that exception.
Okay. And there was also something interesting in the sources about how certain payments people get, like through payment apps or online selling, might be reported for taxes.
Ah, yes. The third-party network transactions. This provision in the sources describes a repeal of a recent revision to the reporting rules.
A repeal. So what does that mean practically?
It means, essentially, that it restores an older, higher reporting threshold. Remember, there was a change to lower it significantly.
Right, down to $600, I think it was going to be.
Exactly. This repeal, according to the source, brings it back to the previous higher threshold, which was $20,000 and 200 transactions.
Wow, okay, so that's a big difference for people doing gig work or selling online sometimes.
It is. Instead of getting a tax form for, relatively small amounts, this change means that higher limit comes back into play. The sources say this is effective for payments made after December 31st, 2025.
So end of next year. Good to know. Okay, let's move on to some completely new deductions introduced in these sources. One that jumped out at me was a deduction for qualified overtime.
Yes, this is a new concept described here. It's a deduction specifically for employees who receive what the text calls qualified overtime pay.
Qualified overtime pay. Does it define that?
The full definition would be in the complete bill text, but the key thing here is that it comes with clear limitations, mainly based on income.
Income limits. The sources spell those out.
They do. The deduction starts to phase down, meaning you get less of it once your modified adjusted gross income goes above certain levels.
Which are?
It's $250,000 if you're single or filing as head of household, and $500,000 if you're married filing jointly, according to the text.
Okay, so it phases out for higher earners.
Right. And the sources explicitly say it's not allowed for highly compensated employees or for folks in certain types of related companies, what they call controlled groups.
Got it. And is this permanent?
No, and this is important. The sources clearly state an expiration date for this one. No deduction allowed for tax years beginning after December 31st, 2028.
So a temporary tax break, it seems. For about 4 years, targeted at certain workers with income restrictions.
That's what the text indicates.
Okay. There's another new deduction mentioned too, right? For passenger vehicle loan interest?
Yes. This section describes a new deduction for interest you pay on a loan taken out after December 31st, 2024. So starting next year.
And the loan has to be specifically for buying a personal use vehicle.
That's what the text says. And it has to be secured by a first lien on that vehicle.
A first lien. So basically the main loan you got when you bought the car, not like a home equity loan you used to buy a car, or a later personal loan where you put the car up as collateral.
Exactly. The source seems very clear on that. It specifically lists exceptions. It says it does not include interest on loans for fleet sales or on personal cash loans secured by vehicles you already owned.
Okay, clear distinction. Anything else on this one?
The sources mention a reporting requirement for the lenders who issue these loans. They'll have to report the interest payments, presumably to the IRS and the borrower.
Makes sense. And is this one temporary too?
Yes, just like the overtime deduction. The sources clearly state an expiration date. No deduction allowed for taxable years beginning after December 31st, 2028.
Another temporary one then, lasting a few years according to the text, okay?
Yeah.
Now let's shift a bit. Potential changes to things like flexible spending arrangements, FSAs, health reimbursement arrangements, HRAs, and health savings accounts, HSAs. These are pretty common ways people save or pay for healthcare.
Right. And these sources introduce several changes that could, potentially expand how you can use these accounts.
Like for FSAs and HRAs?
Yes. One notable change mentioned here is that starting with plan years after December 34, 2025, these accounts, FSAs and HRAs, could be used for something the sources call direct primary care service arrangements.
Direct primary care. What is that according to the sources?
They actually provide a definition. It's described as an arrangement where you pay a fixed periodic fee for primary care services instead of paying per visit.
Like a membership model for primary care.
That seems to be the idea. The sources even put limits on these fees if you want to use FSH or money for them. Yes, $150 per month for an individual, or $300 per month for a family. And that's an aggregate limit, the text says, across all such arrangements you might have.
Okay. And does it say what kind of services don't count under this?
It does. The text explicitly lists services that are excluded from being treated as primary care for this purpose. Things like procedures needing general anesthesia, certain prescription drugs, though vaccines are okay, and some lab services not typically done in a primary care office.
So it seems designed to let people use pre-tax FSA HRA dollars for these specific primary care membership models, but with some pretty clear boundaries defined in the source.
Exactly. It's integrating them into these existing accounts, but carefully.
What about health savings accounts? HSAs, those are really popular. Any changes there in the sources?
Yes, a couple of things. The sources detail changes allowing HSAs to be used for what the text defines as qualified sports and fitness expenses.
Sports and fitness, using HSA money.
That's what the text says. Effective for tax years beginning after December 31, 2025, so starting in 2026.
And what counts as qualified sports and fitness expenses, according to the definition in the source?
The definition provided in the text is pretty specific. It includes things like memberships, think gym memberships equipment, and programs related to sports and fitness.
So potentially, you could use your HSA for your gym membership, maybe kids' sports programs, that sort of thing, based on that definition.
Based on the definition on the source, that seems to be the intention, allowing HSA funds to cover those specific types of expenses.
Interesting expansion. Anything else for HSAs?
The sources also covered changes related to HSA contribution limits when spouses are involved. That's also effective for tax years starting after December 31st, 2025.
Okay. And what about moving money around, like Can you get money from an FSA into an HSA based on these sources?
Yes, the text includes provisions that seem to allow for terminating an FSA or HRA and then converting those funds into an HSA. It defines something called a qualified HSA distribution from these accounts.
Ah, so outlining the rules for how you could potentially make that transfer without penalties? Sounds like new flexibility.
It does seem that way based on the description. There's also a new eligibility rule mentioned for making HSA contributions if your spouse has a health FSA that covers you.
Right, that interaction can be tricky now. Finally, on HSAs, the sources mention inflation adjustments.
Yes, the text includes the mechanism for adjusting HSA contribution limits and other amounts for inflation each year. However, it specifies that the effective date for these inflation-adjusted contribution amounts is for taxable years, beginning after December 31st, 2026.
So the current limits stick around through 2026, and then inflation adjustments kick in starting in 2027, based on what the text says.
That's how it reads in the source material, yes.
Okay, that's quite a bit for the pocketbook section. We covered changes to existing tax rules, some new but temporary deductions, and some potentially significant expansions in how people can use their health savings accounts.
A lot to digest there on the personal finance side.
Definitely. Now let's shift gears. Let's look at how these sources describe potential impacts on social safety nets and healthcare access. We'll focus on what the text says about the Medicaid and SNAP programs, and also touch on the Affordable Care Act's exchanges.
Right. This next section of the sources outlines some pretty significant proposed changes to these programs. They could affect eligibility, how the programs ensure integrity, and how services are structured and funded based on the text.
Starting with Medicaid, the sources mention several provisions aimed at preventing what the text calls abusive practices.
Yes, things like preventing abusive spread pricing, which relates to how pharmacy benefits are managed.
Okay, what else?
The text also explicitly prohibits using federal Medicaid and Children's Health Insurance Program CHIP funding for gender transition procedures.
A direct prohibition mentioned in the sources.
Yes, and it includes a prohibition on federal payments going to certain entities.
Certain entities. Does it specify which ones?
The excerpt we have doesn't list them specifically, but it suggests a move to exclude particular types of providers or organizations from getting Medicaid or CHIP funds. The details would likely be elsewhere in the full bill text.
Okay. Moving on to how states get funding for Medicaid. The sources mention sunsetting the eligibility for increased FMAP for new expansion states. FMAP. That's the federal matching rate, right? The percentage the federal government pays.
That's exactly right, the federal share of the costs. And the sources indicate that states that newly expand Medicaid eligibility under the ACA would, after a certain point, lose access to that enhanced federal matching rate they currently get.
So potentially making it more expensive for states to expand Medicaid later on.
That seems to be the implication in the text. There's also a moratorium described on new or increased provider taxes.
Provider taxes. States sometimes use those to fund their share of Medicaid, don't they?
They do. Taxes on hospitals or other healthcare providers. This provision seems to put a pause on states starting new taxes like that or increasing existing ones as a way to fund Medicaid. The sources also discuss requirements related to waiving uniform tax requirements for these providers.
Okay. Now, one of the most detailed parts in the sources for Medicaid seems to be the introduction of community engagement requirements.
Yes, this looks like a significant new mandate described in the text. It applies to individuals receiving Medicaid who are deemed applicable individuals.
Applicable individuals. And they'd have to do what?
During their regular eligibility redetermination process, they would be required to demonstrate community engagement.
Community engagement, like work requirements.
The term used is community engagement, and the sources do define work programs as one way to meet it, but also educational programs. We'll get to the definitions. But first, the process. While eligibility checks are usually periodic, the sources say states may choose to verify this community engagement status more frequently.
More frequently than, say, once a year.
Potentially, yes. The text gives states that option.
And how would states check this? Do people have to submit proof constantly?
The sources require states to first try verifying it through other data sources, what they call ex parte verifications, without making the individual submit paperwork right away.
Okay, try to check electronically first.
Right. But if that doesn't work, the sources are very specific about what states must do next. They have to send notifications.
Notifications explaining what?
Explaining exactly how to comply with the requirement, clearly listing the exceptions, because not everyone is subject to this, detailing the consequences of not complying, decline, which presumably means losing coverage, and explaining how people can report changes in their situation that might make them eligible for an exception later on.
Wow, that sounds like a really significant administrative lift for the states.
It does, and potentially a new hurdle for individuals trying to maintain their coverage.
You mentioned exceptions. Who is considered an applicable individual subject to this, and who is exempt according to the sources?
The sources provide a definition and then a list of exceptions. Generally, you're an applicable individual unless you fit into one of the exempt categories.
Who those categories are?
The text lists them. People under 19 or over 65. Individuals with a disability, defined by referencing another part of the Social Security Act. People certified by a doctor as medically frail. Those who are pregnant, including a postpartum period. And importantly, individuals who are the primary caregiver for a child under age 6 or for an incapacitated person.
So if you fall into one of those groups, the sources say you're exempt from this community engagement rule.
Correct, based on the list provided in the text.
And you said the text defines what counts as community engagement.
Yes, it provides definitions for educational program and work program in this specific context. An educational program includes being enrolled in college or career and technical education.
And a work program.
That's also defined, listing specific activities that would count towards meeting the requirement. The sources also say the Secretary of Health and Human Services has to issue guidance on how to implement all this by December 31st, 2025.
So guidance is expected by the end of next year, and I think there was even mention of funding to help states set this up. Government efficiency grants.
Yes, the sources do propose dedicated funding through these grants to help states build the systems and processes they'd need to track and verify this community engagement for Medicaid recipients.
Okay, beyond that major requirement, what other Medicaid integrity measures are mentioned in the sources?
There are a few. One requires the Secretary to set up a system by October 1st, 2029, specifically to prevent people from being enrolled in Medicaid in multiple states at the same time.
Prevent duplicate enrollment. Makes sense.
Another requirement, starting January 1st, 2028, is for states to check the Death Master File, that's a national database of deaths, on a quarterly basis.
To identify.
To identify both enrollees and participating providers who have died. This seems aimed at stopping payments or services for deceased individuals or payments to deceased providers.
Another integrity measure. Anything else?
Yes. Starting January 1st, 2027, managed care organizations and similar prepaid health plans that states contract with must promptly send updated address information for enrollees back to the state Medicaid agency.
Why is that important?
Having accurate addresses is crucial for things like sending out renewal notices or the new community engagement notifications we just discussed. It helps ensure people get important information about maintaining their coverage.
Right. The sources also note something about removing the good faith waiver for payment errors.
Yes. That could mean states face stricter financial penalties or accountability if they make errors in Medicaid payments.
And one more Medicaid item, an option for states regarding the homestead exemption.
Correct. The text describes an option allowing states to apply the homestead exemption, which protects the value of a person's home when determining eligibility without having to meet the usual statewide-ness or comparability requirements. This might give states more flexibility in how they apply home equity rules for certain Medicaid pathways, maybe for long-term care.
Okay. Before we leave the healthcare topic entirely, the sources spend quite a bit of time on pharmacy benefit managers, PBMs, but specifically within Medicare Part D, the prescription drug benefit.
Yes, these provisions are detailed and are set to be effective for plan years starting on or after January 1st, 2028. They impose some pretty extensive new reporting requirements.
On whom?
On the PBMs themselves, their affiliates, and the Medicare Part D plan sponsors that hire them.
And what do they have to report, according to the sources?
The text says they must report detailed information on all discounts, rebates, concessions, fees, and any other payments they or their affiliates receive from drug manufacturers, pharmacies, or other entities involved in the drug supply chain.
That sounds like a lot of detail, trying to get transparency into where the money flows.
That appears to be the goal described in the sources, yes. Shedding light on the complex financial arrangements between PBMs, drug makers, pharmacies, and the Part D plans.
And is this reported data public?
Generally, no, according to the sources. The text specifies limitations on disclosure. Information reported under these rules that isn't already public generally can't be disclosed by the government or the Part D plan's sponsor.
But there are exceptions.
Yes, the text lists specific exceptions where disclosure is allowed. For example, for carrying out the Part D program itself, for review by government oversight bodies like the Comptroller General or MedPAC, or for law enforcement purposes by the Attorney General or Inspector General.
Okay. And the sources also provide definitions for terms like affiliate or prohibited payments in this context.
They do, and it also notes something interesting, that the Paperwork Reduction Act doesn't apply here.
What does that usually mean?
It often signals that the data collection is mandated and might be expedited, bypassing some of the usual review processes for government paperwork burdens.
Got it. Okay, that covers a lot on Medicaid changes, community engagement, integrity measures, and these new PBM reporting rules for Medicare Part D, all based on the sources. Now let's switch to the Supplemental Nutrition Assistance Program, or SNAP. Food assistance. What changes are outlined there in the sources?
The sources describe several changes to SNAP, affecting both how benefit amounts are calculated and who qualifies.
Like how benefits are calculated.
One key change mentioned relates to the Thrifty Food Plan, which is the basis for setting benefit amounts. The text states that the cost of this plan is to be adjusted annually based on changes in the Consumer Price Index for all urban consumers.
So benefit levels would be updated each year based on general inflation, according to the sources.
That seems to be the mechanism described, yes, an annual adjustment tied to the CPIU.
Are there changes to deductions that people can take which also affect their benefit amount?
Yes, the sources mention changes to the excess medical expense deduction. It specifically notes this applies to households that include an elderly or disabled member. The details of the change itself would be in the full text.
Okay. Any other deduction changes?
The sources also place restrictions on deducting internet expenses when calculating a household's net income for SNAP eligibility.
So maybe limiting or eliminating the ability to count internet bills as a deductible expense for SNAP.
That appears to be the direction based on the text mentioning restrictions.
What about eligibility itself? Are the requirements changing, according to the sources?
Yes, this looks like another potentially significant change. The text lays out revised eligibility requirements.
Which are?
It states that to be eligible for SNAP, an individual must be a resident of the United States and also either a U.S. citizen or national or classified as a qualified alien.
Resident plus citizen national or qualified alien status. That sounds like it could affect mixed status households.
It could, and the sources actually address that situation directly. There's a specific rule described for households where one member becomes ineligible under these rules, but the rest of the household is still eligible.
What happens then? Does the ineligible person's income just disappear from the calculation?
No, the opposite. The text specifies that the income and financial resources of that ineligible individual shall be considered when determining the household's overall eligibility and their final SNAP allotment value.
So even if someone in the house can't get benefits themselves due to this rule, their income still counts against the rest of the family's benefit amount.
That's what the source text describes. It seems designed to prevent households from getting a higher benefit simply because one member is ineligible under these specific criteria. The sources also mention emergency food assistance briefly, mostly referencing updates to the underlying law, but the main focus in these excerpts is on the Thrifty Food Plan adjustment, the deduction changes, and these revised eligibility rules.
Okay. Lastly, for this section, let's look at the Affordable Care Act, the ACA, specifically the health insurance exchanges or marketplaces and the premium tax credits that help people afford coverage there. What impacts do the sources describe?
The sources include provisions that seem designed to modify how people enroll and how their eligibility for financial help is verified.
Like enrollment periods.
Yes. One key change is a prohibition. It says the Secretary of Health and Human Services cannot require the exchanges to offer special enrollment periods based solely on an individual's income level relative to the federal poverty line.
Solely based on income. When would that take effect?
The sources state this is effective for plan years beginning on or after January 1st, 2026.
But does that mean all special enrollment periods related to income go away? What if your income changes and you become newly eligible for subsidies?
Good question. The source includes an important exception. It says this prohibition does not apply to special enrollment periods that are based on a standard change in circumstances or a qualifying life event, like losing other job-based coverage, getting married, having a baby. The usual triggers.
Okay, so the standard qualifying life events still grant enrollment periods. It's just that being low income by itself wouldn't automatically trigger a special enrollment period under this provision.
That's how the text reads. The sources also introduced new verification requirements for people applying for the advance payments of the Premium Tax Credit APTC. Those are the subsidies paid upfront to lower monthly premiums.
More verification. What does that involve based on the sources?
Applicants have to attest to, basically swear to, what they project their annual household income will be for the year they want coverage.
Okay, self-attestation.
Yes, but then the sources require the exchanges to use third-party data like information from the IRS or Social Security to try and verify that attested income.
Check it against official records. What if there's a mismatch?
The text says if the income the person attests to is higher than the third-party data by more than a reasonable threshold, whatever that means, then additional verification requirements might kick in.
So a mechanism to flag and potentially require more proof if someone's self-reported income seems significantly higher than what government data shows.
That appears to be the process described.
And there was something specific about immigration status attestation.
Yes, the sources mention that a specific attestation regarding immigration status is required for non-citizens who are eligible for APTCs as part of this verification process.
Okay. Anything else on verification or enrollment?
The sources also require individuals who receive these advance payments to file a tax return and reconcile the credit annually. This is largely the current rule, but its re-emphasis here alongside the enhanced verification is noted in the text.
You have to file taxes to keep getting the subsidies.
And one more change regarding enrollment. The sources describe a requirement to prohibit automatic re-enrollment from a bronze level plan to a silver level plan on the exchange.
Prohibit auto-enrollment from bronze to silver. So if you're in a bronze plan and don't actively choose a plan for the next year, the exchange couldn't automatically move you up to silver.
That's what the text seems to indicate. This change is effective for re-enrollments for plan years starting on or after January 1st, 2026, according to the sources.
Okay, that definitely covers a range of areas within safety nets and healthcare access, as described in these sources: Medicaid rules, SNFP calculations and eligibility, and ACA verification and enrollment processes. Let's shift now to what the sources say about, well, driving the economy. Business, jobs, investment incentives laid out in the bill.
Right. This next section of the sources gets into various tax incentives and some regulatory changes that seem aimed at stimulating certain kinds of economic activity, particularly for businesses and domestic production.
Like that special depreciation allowance for qualified production property.
Yes, that's a big one described here. It essentially allows businesses to deduct 100% of the cost of certain property in the year they put it into service.
Instead of spreading that deduction out over many years.
Exactly. It's often called bonus depreciation, and getting 100% upfront is a significant acceleration of the tax benefit. But the sources attach this to a very specific timeline.
A timeline.
Yes. The text states that construction of the property has to start after January 19, 2025, and before January 1st, 2029. And the property itself has to be placed in service before January 1st, 2029.
So a defined window there. And what kind of property qualifies? How is qualified production property defined in the sources?
According to the sources, it's tangible personal property used as an integral part of a qualified production activity. It has to be placed in service in the U.S. or a U.S. possession. Its original use has to start with the taxpayer claiming the deduction, and the taxpayer has to elect to use this special allowance.
And qualified production activity.
That's defined in the text as a trade or business involved in producing qualified products. The specifics of qualified products would be elsewhere. But like some of the individual deductions we talked about, this special depreciation has an explicit end date mentioned in the sources.
When does it end?
It ends January 1st, 2029. So based on the text, this appears to be a temporary measure designed to encourage specific types of domestic production investments within that roughly 4-year window.
Another temporary incentive then. What about how businesses treat R&D spending, research and experimental expenditures?
The sources outline temporary rules for the tax treatment of domestic research and experimental costs.
Temporary rules again. How long did these last, according to the sources?
These revised rules, as described, are effective for tax years starting after December 31st, 2025, and they expire for tax years starting after December 31st, 2029.
So a 4-year period for those different rules.
Yes, and the text indicates that after that, the tax treatment reverts to the prior law, so it's explicitly a temporary change to how businesses deduct those specific costs.
Okay. The sources also mention some extensions related to complex international tax rules, GILTI and BEAT. Those mostly affect larger multinational companies, right?
That's correct. The text indicates an extension of the limitation on the deduction for global intangible low-taxed income, or GILTI, and also an extension of the base erosion minimum tax amount, known as BEAT. These are indeed complex rules for multinationals, and the sources simply state their limitations are extended.
Got it. And there's also an extension mentioned for the tax credit businesses can get for providing paid family and medical leave.
Yes, the sources indicate that credit is extended through the end of 2025, but importantly, it continues after that at a reduced rate, according to the text.
So the full credit is extended short term, then it scales back.
That's what the description suggests.
All right. Let's move on to opportunity zones. These were created a few years ago to encourage investment in economically distressed areas. What did the sources say about them? Renewal. Enhancement.
Yes, both. A key provision described here extends the designation period for areas to be qualified opportunity zones. The sources say that designation is extended pretty significantly out until December 31st, 2031.
Okay, so the zones themselves stick around longer. What about the enhancements the sources mention?
Well, the sources list several things they call enhancements. There's a provision for a consolidated basis increase for investments made after December 31st, 2026. That relates to how capital gains on opportunity zone investments are eventually taxed, potentially reducing the tax burden.
Okay, what else?
The text also introduces a new category, qualified rural opportunity zones.
Rural opportunity zones, a subset.
It appears so. And related to that, there's a special rule described for improving existing buildings within opportunity zones that are entirely rural.
A special rule for rural zones.
Yeah. It allows for a lower threshold for substantial improvement. Normally, to get certain tax benefits, you have to invest at least as much in improving a building as you paid for it. That's the 100% basis improvement rule. But for existing structures in these qualified rural zones, this special rule lowers that requirement to just 50% of the original adjusted basis.
So less investment needed to qualify for improving buildings in rural OZs.
That's what the text indicates.
And I think the sources specifically mentioned this lower requirement applying to data centers in those rural areas.
That's correct. The text makes a specific note that this reduced 50% basis improvement rule for existing structures in rural zones applies to data centers located there.
Interesting detail. Now, besides these enhancements, the sources also introduce entirely new reporting requirements for opportunity zones.
Yes, this seems like a significant addition. New reporting is required for both the qualified opportunity funds, the investment vehicles, and the actual qualified opportunity zone businesses operating within the zones.
What kind of information do they have to report based on the sources? This sounds like it could be a lot.
It does sound quite detailed based on the description. The required information includes the basics like name, address, taxpayer ID number, but also the fund or business structure, like if it's a corporation or partnership.
Okay, standard stuff. What else?
It gets more detailed. They need to report the total value of assets held, specifics on the investments made, property held, the types of business activities conducted, and significantly detailed employment data.
Employment data. Like what?
The text specifies reporting the distribution of employees by their industry classification code, that's the NAICS code, and also the number of new business starts within the zone that are related to the opportunity zone investment.
Wow, that's getting granular. Trying to track the actual impact on jobs and new businesses.
It certainly seems aimed at increasing transparency and data collection on what's happening within these zones. The sources also mention that the Treasury Secretary has to set up procedures to protect confidential taxpayer information when releasing reports based on this data.
Okay, that level of reporting is definitely a change for opportunity zones. What other business or investment provisions are mentioned in the sources?
There's an exclusion from gross income mentioned for interest received on certain loans secured by rural or agricultural real property.
So making lending in rural areas potentially more attractive for lenders.
That could be the effect. This exclusion is effective for loans made after December 31st, 2025, and the text provides definitions for what counts as a qualified loan and what qualifies as rural property for this purpose.
Got it. Any temporary exclusions?
Yes, there's a temporary exclusion from gross income described for income that comes from selling certain agricultural or fishing products.
Temporary again. What's the time frame on that one?
This exclusion applies for tax years starting after December 31st, 2024, and as described in the sources, it ends after December 31st, 2029, so about a 5-year window.
Is there a related new tax mentioned alongside that?
Yes, interestingly, the sources introduce a new tax on net investment income, but they explicitly exclude income derived from certain rural or agricultural property from this new tax. Seems to align with that exclusion we just mentioned.
Okay. And finally, anything about reporting by partnerships or S corporations?
Yes, there are changes described related to how partnerships and S corporations report income from what's called a specified service trade or business. The details of that reporting change are in the source text.
All right. That wraps up a pretty wide range of business tax and investment changes outlined in the sources: incentives, depreciation, opportunity zone changes, new reporting, rural focus. Let's dive into the next big section, Section 4. This covers border security provisions, those new Trump accounts, and various sector-specific policies mentioned in the sources.
Okay. Starting with border security, the sources detail some significant proposals for funding and operations.
I saw mention of a pretty large chunk of money for the Department of Homeland Security, DHS.
Yes, a very significant appropriation. The sources specify $12 billion, that's billion with a B, for fiscal year 2025, intended for DHS border security activities.
$12 billion. And how long would that funding be available?
The text states these funds are available for DHS to use until September 30, 2029, so it's multi-year funding.
And how are these funds supposed to be used? According to the sources, does it go directly to federal agencies?
Interestingly, the text says the Secretary of Homeland Security shall use these amounts to make grants to states.
Grants to states.
Mm-hmm.
For what specifically?
Specifically for costs the states incur related to border security activities. The sources even list eligible uses for these state grant funds.
Like what? What can states spend this money on?
The list in the sources includes costs for state personnel involved in border security that could be National Guard, state police, local law enforcement. It also covers costs for building or leasing facilities for processing or detaining individuals encountered at the border.
Okay. Personnel and facilities. Anything else?
Yes, transportation costs, medical support, providing food and supplies. Also, costs related to notifying the federal government about individuals encountered and complying with federal requests for information about them.
So it really seems designed to directly fund state-level operations and costs associated with the border, according to the text.
That's what the description of these state grants suggests, yes.
Now, the sources also detail changes to immigration fees, not for entering the country, but fees collected by the immigration courts, right?
Right.
EOIR.
Correct. The Executive Office for Immigration Review. The text specifies increases in the fees for filing certain types of applications and motions within the immigration court system.
Which kinds of applications or motions?
The sources mention increased fees for motions to reopen prior removal orders, applications for suspension of deportation, an older form of relief, and applications for cancellation of removal and adjustment of status, which is a common way people seek relief from deportation in court.
And are these fee increases a one-time thing, or do they change?
The sources state these specific fees will be subject to annual adjustments for inflation starting in fiscal year 2026.
Okay, adjusted annually, and where does that fee money go?
This is notable. The text specifies that the fees collected from these applications and motions are to be retained by EOIR itself.
Rather than going into the general government fund.
Exactly. It appears earmarked to stay within the immigration court system based on that description.
Interesting. What about personnel? Any provisions in the sources for immigration and customs enforcement, ICE?
Yes, the sources include provisions for bonuses specifically aimed at ICE agents, officers, and attorneys.
Bonuses, like retention bonuses.
Yes, a retention bonus of $15,000 is mentioned for current personnel who commit to serving for 2 additional years. And there's also a signing bonus described.
For new hires.
Right, $15,000 for new hires who commit to at least 5 years of service. These seem clearly aimed at boosting recruitment and retention within ICE based on the text.
Okay. And one more item related to states and immigration costs. A program to reimburse states for incarcerating certain individuals.
Yes, the sources detail a program for reimbursing states for costs associated with incarcerating what the text calls certain illegal aliens.
Does it specify who qualifies for this reimbursement?
It does. The text lists criteria based on the individual's immigration status or situation. For example, being subject to removal proceedings, having failed to maintain legal non-immigrant status, or being specifically designated by the Secretary of Homeland Security.
So it seems intended to offset some of the costs states bear for holding certain non-citizens in their jails or prisons, according to the text.
That appears to be the goal described.
All right. Moving away from border security now. The sources introduced something completely new called Trump accounts for newborns. What are these, based on the text?
They are described in the sources as a brand new type of tax advantage savings vehicle. The text says they'd be effective for tax years starting after December 31st, 2024.
A new savings account. What's its purpose, according to the text?
But the sources say a Trump account is set up for the benefit of a specific individual, the account beneficiary. While the overall purpose isn't broadly stated in the excerpt, there's a description of an associated pilot program.
A pilot program.
Yes, and that pilot program description references providing a contribution for a qualifying child. So that strongly suggests these accounts are designed, at least initially, for newborns or young children.
Okay. Is there a limit on how much you can put into one of these Trump accounts?
Yes, the sources state an annual contribution limit of $5,000 per account.
$5,000 per year.
Right. But it also clarifies that contributions from tax-exempt sources, like maybe government contributions and qualified rollover contributions, wouldn't count towards that $5,000 limit from, say, parents or grandparents.
Got it. And what's needed to set one up, according to the sources? Any specific requirements mentioned?
The sources mention requirements for the legal document, the trust instrument that establishes the account. It has to include the Social Security numbers of both the person setting up the account and the child beneficiary.
Okay. And you mentioned a pilot program. Tell me more about that.
Yes, there's a section describing a Trump account's contribution pilot program. This program, according to the sources, provides a one-time $1,000 payable tax credit.
A $1,000 credit.
To whom? To taxpayers for each eligible individual, which is defined in this context as a qualifying child of the taxpayer. So basically a $1,000 contribution from the government for newborns structured as a tax credit.
And when would that pilot program take effect?
The sources state this pilot program is effective after the bill's enactment.
Now, the obvious question people might have is how these compared to existing things like 529 college savings accounts. Do the sources make any comparisons?
No, the text in the sources we have focuses strictly on describing the structure of these new accounts, the limits, the setup, the pilot program. It does not include any comparisons to 529s or other existing savings options. We have to stick just to what's in the text provided.
Understood. So a new savings vehicle aimed at newborns, 5K annual limit, with a fund allocate pilot program contribution via tax credit. That's the picture from the sources. Okay, let's move to energy and environmental policy changes outlined in the sources. This looks like another area with a lot going on.
It really is. Numerous provisions impacting the energy sector, land management, and environmental regulations are described in these sources.
Where does it start? I think it mentions rescinding funds from the Inflation Reduction Act.
Yes, the text mentions rescinding unobligated balances, basically. Taking back money that hasn't been spent yet from specific clean energy programs that were funded by the IRA.
Which program specifically?
The sources mention state-based home energy efficiency contractor training grants as one. Also, funding for the Department of Energy's Loan Programs Office, which supports various energy projects. The unobligated funds for those would be canceled, according to the text.
Okay, pulling back some IRA funding. What about fossil fuels? Anything on natural gas pipelines?
Yes, the sources describe measures aimed at streamlining the permitting process for natural gas pipelines and related facilities under the Natural Gas Act.
Streamlining. What does that mean in practice, based on the sources?
Well, one key thing is establishing a standard one-year deadline for federal agencies to make decisions on certain applications for these projects.
A one-year shot clock for permits.
Seems like it. The sources also impose limitations on judicial review of agency decisions made under these streamlined processes.
Limiting court challenges.
It appears intended to make it harder to challenge or block these projects in court based on procedural issues related to the permits based on the description.
Okay. And there's something mentioned in the sources about an energy independence and security fund. What's that?
This is described as a new fund. Its funding mechanism can include contributions from the sponsors of energy projects up to 5% of the project costs, according to the text.
And what's the fund for?
Its key purpose, as described in the sources, is to provide compensation to energy projects if a qualifying federal action happens after they've gotten their approvals, and that action either revokes their approval or makes the project economically unviable.
Compensation if the government changes the rules or blocks a project later. Yeah. What counts as a qualifying federal action here, according to the sources?
The definition in the sources is quite specific. It includes a regulation, an administrative decision, or an executive action that occurs after the project got its federal permit or approval, and which revokes it or makes the project non-viable. And here's a crucial part of the definition in the text. This applies regardless of whether the regulation, administrative decision, or executive action is responsive to a court order.
Regardless of a court order. So even if a court tells a federal agency to stop a project, this fund could still potentially compensate the project developers.
That seems to be the design described in the sources. It appears aimed at providing a sort of insurance or compensation for energy projects against future federal actions that halt them, even if those actions are mandated by the judiciary.
That's significant. What about oil and gas leasing on federal lands? What do the sources say there?
The sources include specific directives for the Secretary of the Interior regarding lease sales. The text requires ensuring sales are conducted immediately upon completion of requirements.
So speed things up.
Yes. It also states that eligible lands comprise all lands subject to leasing under this section, which sounds like it could potentially broaden the scope of lands considered available for leasing.
And doesn't it mention a specific percentage requirement for offering parcels in some states?
It does. In certain states, which would be listed elsewhere, the sources require the Secretary to offer not less than 50% of all the parcels nominated by industry that are available and eligible in each lease sale.
So mandating that at least half the nominated eligible land gets offered seems aimed at increasing the amount of land offered for leasing.
That's the clear direction indicated in the text, yes. Accelerating and expanding the offering of federal lands for oil and gas.
Now, while pushing leasing, do the sources also mention new fees related to oil and gas on federal lands?
Yes, they do. New fees are established for various steps in the onshore oil and gas permitting process and for environmental reviews.
Fees for what, exactly?
For things like environmental assessments, EAs, environmental impact statements, EIS, findings of no significant impact, FONSIs, and records of decision, ROD, basically the paperwork and review process.
So industry pays more for the process. Does that come with anything else?
Interestingly, yes. The sources also state that there shall be no judicial review of an environmental assessment or environmental impact statement for which a fee is paid under this section.
No court review of the EA or EIS if the fee is paid.
That's what the text says. And it adds that court review of the related FONSI or RD can't challenge it based on problems with the underlying EA or EIS.
So pay the fee, get less potential for legal challenges based on the environmental review documents.
That appears to be the trade-off described. Add costs, but limit legal exposure based on those specific documents. The sources also mention a general increase in other fees and in the royalty rates paid for oil and gas produced on federal lands.
Okay, so measures seemingly aimed at both increasing activity but also increasing costs and limiting review for fossil fuels. What about renewable energy on federal lands? Wind and solar.
The sources introduce new annual fees for renewable energy projects that have a right-of-way on public lands.
Annual fees for wind and solar farms on public land. What are these fees based on?
Two types are mentioned in the sources. First, an acreage rent, which is calculated using a formula. Second, capacity fees, which are set as the greater of either the acreage rent or a fee based on the project's electricity generating capacity.
So they pay based on land used, or potentially more based on how much power they can produce.
That's the structure described.
Is there any flexibility for when projects have to start paying these fees? Like, do they pay while they're still under construction?
There is an exception mentioned. The sources say that project holders can delay paying the acreage rent portion until the date the project actually starts generating electricity.
Okay. So some relief during the construction and development phase, at least for the land rent part.
Seems so, based on that exception in the text.
Now, besides energy-related funding cuts, the sources also mention rescissions from other land management agencies.
Yes. Similar to the DOE funds, the text mentions rescissions of unobligated balances from certain funds within the U.S. Forest Service, the National Park Service, and the Bureau of Land Management, BLM.
Taking back unspent money there, too. And something about timber harvesting.
Yes, a specific requirement for the BLM. The text directs the agency to manage timber harvests on certain covered public lands at levels equal to or exceeding 25% higher than the historical average volume for those lands.
Mandating a significant increase in logging targets on those specific BLM lands.
That's what the directive in the source says.
Okay. Finally, under energy, the sources circle back to tax credits, but this time mentioning rescinding or restricting various clean energy tax credits.
Yes, this contrasts with the fossil fuel provisions. The sources indicate that a number of clean energy tax credits, things like credits for clean fuel production, carbon capture, sequestration, zero-emission nuclear power, clean hydrogen, advanced manufacturing related to energy, and investment credits for energy property are either repealed entirely, restricted in their scope, or scheduled to phase out according to the provided text.
So a definite scaling back or elimination of several key clean energy incentives based on these sources.
That appears to be the case described here.
And there are also provisions mentioned that restrict who is eligible for certain energy credits based on foreign ownership or influence.
Yes, the sources include rules that would make certain entities ineligible for some energy tax credits, like those for electricity production or energy storage technology.
Which entities are restricted?
The text refers to them as specified foreign entities or foreign influenced entities. It provides specific definitions, often based on ownership structure, like how much is owned by entities from certain foreign countries, or whether the company makes payments to certain prohibited foreign entities.
So aiming to limit foreign involvement or benefit for certain countries in U.S. energy projects receiving these tax credits.
That seems to be the intent described in the text, yes.
Okay, wow. That was a really detailed look at the energy and environmental provisions described in the sources. Covered a lot. Fossil fuels, renewables, permitting changes, funding cuts and shifts, new fees, tax credit changes, a real mix. Now let's cover some miscellaneous provisions outlined in the sources that touch on a range of other topics.
Right, a bit of a catch-all section here in the sources.
Okay.
One interesting provision deals with artificial intelligence, AI.
AI regulation. What do the sources say? Is it setting up federal rules?
Not exactly setting up federal rules, but rather putting limits on state and local authority to regulate AI.
Limiting states and cities. How?
The sources state that states and localities are prohibited from imposing requirements on AI models or systems unless one of two conditions is met.
Okay, what are the conditions?
Either the requirement is already mandated by federal law, or the requirement is imposed in the exact same way, under a generally applicable law, on non-AI systems that do something comparable.
So states can't create unique AI-specific regulations unless they're just applying existing general rules, or unless the federal government requires it. Sounds like federal preemption almost.
That seems to be the effect described in the text, yes. Aiming for some standardization or preventing a patchwork of state AI rules unless they mirror existing regulations for similar non-AI tech or follow federal mandates.
Okay, what about firearms? The sources mention a change to a tax related to firearms.
Yes, specifically a change in the tax imposed under the Internal Revenue Code on the making of what the code calls any other firearm.
The making of any other firearm. What's the change?
The text states that the tax for making a firearm in this category is set at $200.
$200. When does that take effect?
The sources specify it's effective for calendar quarters beginning more than 90 days after the bill is enacted.
Now, does the source text we have define what any other firearm includes? Does it specifically mention things like silencers, which are sometimes classified that way?
The specific excerpt provided for this section does not define any other firearm, nor does it explicitly name silencers or any other specific items. It simply states that the tax on the making of a firearm falling into the category any other firearm is now $200, replacing whatever the previous rate was for that category. We have to stick strictly to what the text says here.
Understood. The source just sets the tax on making that specific category at $200.
Okay, what's next? Filing fees for the Merit Systems Protection Board. That's the Board for Federal Employee Appeals, right?
Correct, the MSPB. The sources describe the introduction of filing fees for federal employees who want to bring claims or appeals before the board.
So employees would have to pay to file an appeal.
That's what the text indicates. However, it also states that the fee is returned to the individual if they win their case, if they are the prevailing party.
Okay, get it back if you win. Are there any exceptions where you don't have to pay the fee up front?
Yes, the sources list specific exceptions. For instance, cases brought by the Office of Special Counsel don't require a fee, and certain types of claims or appeals related to specific prohibited personnel practices, as defined elsewhere in law, are also exempt from the fee.
So a potential new cost for some federal employees seeking appeals, unless they fall under an exception or ultimately win their case.
That seems to be the structure described.
Now, the sources also introduced entirely new taxes on college endowments. Yes, this is a significant new tax described in the sources. It's effective for taxable years beginning after December 31st, 2025.
And which colleges would be hit by this, according to the sources? All of them.
No, the sources detail specific criteria for which institutions are subject to it. Generally, they have to be eligible educational institutions, but not public colleges or universities. They need to have had at least 500 tuition-paying students in the previous year, and they have to meet certain endowment value thresholds.
Endowment thresholds.
Yes.
Are there different tax rates based on how big the endowment is?
Yes. The sources outline tiered tax rates. It's based on what the text calls the student-adjusted endowment, basically, the endowment value per student.
Okay, per student value. What are the tiers?
Institutions with a student-adjusted endowment between $1.25 million and $2 million would be taxed at 15% on their net investment income. And those with a student-adjusted endowment over $2 million per student would be taxed at 21%.
So clearly targeting wealthier private colleges and universities with substantial endowments relative to their student body size, based on those criteria and thresholds in the sources.
That appears to be the focus, yes.
What about private foundations? The sources mention changes to the tax on them as well.
Yes, the sources describe an increased tax rate imposed on the net investment income of private foundations. This is also effective for tax years beginning after December 31st, 2025.
Increased tax, is it tiered like the endowment tax?
It is tier based on the foundation's total asset size, according to the sources.
What are the tiers for foundations?
Foundations with assets less than $50 million are taxed at 1.39%, which is the current rate. Those between $50 million to $250 million face a 2.78% rate. Between $250 million and $5 billion, the rate is 5%. And for foundations with $5 billion or more in assets, the rate is 5.25%.
Wow, so a significant jump and a new tiered structure for the tax on private foundation investment income, especially for the largest foundations, based on the source description.
It seems so. The text also lists certain exclusions from this tax.
Okay. Are there also changes mentioned related to corporate charitable giving? Deductions.
The sources mention changes related to the limitation on the deduction corporations can take for their charitable contributions. The specifics of how that limitation is changing are described in the relevant section of the text.
Got it. And finally, one more new tax introduced in the sources, a tax on remittance transfers. What are those?
Remittance transfers are essentially money transfers, often sent internationally by individuals working in one country back to family in another country.
Okay. And there's a new tax on those transfers described.
Yes. The sources describe a new tax imposed at a rate of 3.5% on the dollar amount of the transfer.
3.5%. Who pays this tax? The sender or the recipient?
The text states the tax is paid by the sender of the transfer, and it's collected by the remittance transfer provider, the company handling the money transfer.
So the provider collects it from the sender? What if they don't?
The sources specify that the provider has secondary liability if they fail to collect the tax from the sender, so they could be on the hook for it.
Is there anyone exempt from this tax?
Yes, there's a very explicit exception stated in the sources. This tax does not apply to remittance transfers sent by citizens or nationals of the United States.
Ah, okay. So, based on the text, this appears to be a new tax specifically targeting money sent out of the U.S. by individuals who are neither U.S. citizens nor U.S. nationals, with the collection burden placed on the money transfer companies.
That's the structure described in this section of the sources.
All right. That covers a really diverse set of miscellaneous provisions detailed in the sources, AI regulation limits, a specific firearm tax change, new fees for federal employee appeals, and significant new taxes on large endowments and private foundations, plus that remittance tax. Phew, that was a lot of information across so many different areas.
It really was a very broad piece of legislation, judging by these excerpts.
Definitely. So now let's try to pull back a little. Let's look at the bigger picture, specifically focusing on temporary versus permanent changes and why those effective dates we kept mentioning are so important. The final sections of the sources seem to help with this.
Right. This part of the sources helps summarize and contextualize some of these provisions by explicitly highlighting their intended duration, as specified in the text, particularly noting those with clear expiration dates.
We definitely flagged several provisions throughout our discussion that the sources explicitly called temporary or gave specific sunset dates. Can we recap some of the key ones that are noted as expiring around, say, the end of 2028 or 2029?
Sure. That group would include the new deduction for qualified overtime. The sources state that expires for tax years beginning after December 31st, 2028.
Okay, overtime deduction ends end of 28.
Also, the deduction for passenger vehicle loan interest. Same expiration. Tax years beginning after December 31st, 2028.
2 new deductions gone after 2028. What else?
Those temporary rules for domestic research and experimental expenditures for businesses. Those, as described in the sources, expire for tax years beginning after December 31st, 2029.
R&E rules revert after 29.
And that special 100% depreciation allowance for qualified production property. Remember the tight window. Construction has to start before Jan 1, 2029, and it has to be placed in service before Jan 1, 2029. So the benefit is effectively limited to that temporary period.
Right.
Also, the temporary exclusion from gross income for selling certain agricultural or fishing products. The sources state that ends after December 31st, 2029.
Okay, so quite a few of these new or modified tax and business provisions are clearly designed as temporary measures in the text, set to sunset within the next, 4 to 5 years.
That's what the dates in the sources indicate, yes.
What about the opportunity zones? The sources extended their designation, right? But was that indefinite?
The designation period for areas to be qualified opportunity zones was explicitly extended until December 31st, 2031 in the sources. And some related benefits, like that consolidated basis increase, apply to investments made after December 31st, 2026. So the program itself gets a longer life, but with specific dates still attached to aspects of it.
Okay, extended but still date limited eventually. And the exclusion for certain student loan discharges being tax-free.
The sources mention that exclusion applies to loan discharges that happen before 2029, so another temporary provision based on that date.
And the business credit for providing paid family and medical leave.
That one, as described in the sources, is extended at its full rate only through 2025. After that, the rate is reduced, so it continues, but in a modified, less generous form after next year.
Okay. Now, on the flip side, what about provisions in the sources that seem more permanent, or at least have effective dates way out in the future, suggesting a longer-term intended change?
Based purely on these excerpts, provisions like the new Medicaid community engagement requirements or the revised SNFP eligibility rules, those don't have explicit expiration dates mentioned here.
Implying they're intended as ongoing changes to how those programs operate.
That's the implication when no sunset date is provided in the text. Similarly, the structure for those new Trump accounts seems set up as a permanent addition to the tax code framework, even though the $1,000 pilot program credit is described separately and might be temporary.
What about the energy stuff? The permitting streamlining the new fees?
Those measures, both the streamlining for natural gas pipelines and the new annual fees for renewables and the permitting fees for oil and gas, are described without sunset dates in these sources. That suggests they're intended as longer-term changes to the regulatory and cost landscape.
And the new taxes on endowments and foundations.
Those also appear set as ongoing taxes effective after December 2025, with no expiration mentioned in the text we have.
What about the border security funding, that $12 billion?
That had a specific duration mentioned. The appropriation is available until September 30, 2029. So it's multi-year, but not indefinite funding for that particular allocation.
Okay. And several of the healthcare changes, particularly around the ACA exchanges and HSAs, had effective dates starting in 2026 or later.
Right. Things like the limits on special enrollment periods and the prohibition on automatic re-enrollment from bronze to silver plans, those kick in for plan years starting January 1st, 2026.
Okay.
The requirement for managed care plans to send address data to states starts January 1st, 2027. The Medicaid Death Master File checks begin January 1st, 2028. And those inflation adjustments for HSA contribution limits start for tax years after December 31st, 2026.
So those future dates are really key to understanding when those specific changes would actually start to impact people or programs based on the text.
Exactly. They aren't immediate changes, but they are scheduled to happen according to the sources.
So maybe you can just sum up for our listener. Why is paying attention to all these effective dates and expiration dates as laid out in the sources so absolutely critical for understanding what this bill might actually do?
Oh, they're fundamental. Absolutely crucial, because the dates tell you precisely when a provision described in the text starts affecting things, and importantly, if and when it stops.
Right.
A temporary deduction, like for overtime or car loans here, only provides a potential benefit for that specific window. You need to know when it ends. A change with a future effective date, like some of those ACA or HSA rules, means you won't see the impact right away, but you know it's on the horizon.
And things without expiration dates.
Those imply a more lasting shift in the rules, the structures, the programs. Think about those Medicaid or SNFP changes or the new endowment taxes. So tracking these dates, as detailed right here in the sources, is absolutely essential if you want to navigate the potential timing, the duration, and the real practical impact of all these different pieces on your life, your family, or your business.
That's a great summary. This deep dive really has covered a huge amount of ground, based purely on these excerpts we have from the One Big Beautiful Bill. We've walked through potential impacts described in the text on taxes, healthcare, safety nets, business incentives, border security, those new savings accounts, energy policy shifts, and a whole host of miscellaneous items.
And throughout, our goal really was just to provide you, the listener, with a neutral, factual understanding of what this text itself contains. We focused on highlighting the specifics, the requirements, the dates, the definitions, the limits, the dollar amounts, all mentioned right here in our sources.
Yeah, presenting the information as it's written, trying to clarify what it says without adding our own spin or taking sides.
Because understanding these specifics, the actual details laid out in the legislative text, is just so incredibly important when you're trying to make sense of a bill this complex, this far-reaching.
It really is. It lets you see the actual mechanisms being proposed, doesn't it?
Exactly. From the precise definition of community engagement for Medicaid or qualified production property for that depreciation break, to the exact income thresholds for deductions or the tiered rates for those new taxes on endowments and foundations.
And seeing those effective dates and expiration dates really adds another layer.
It does. It reveals the intended timeline, the potential duration of these policies, helping you build a much clearer picture of the potential impact drawn directly from the source material itself.
Well, thanks for joining us for this deep dive into the sources on the One Big Beautiful Bill.
Yes, thank you. We really hope this in-depth look at the specifics, just based on these legislative excerpts, has helped you feel significantly more informed about what the text actually contains. Maybe consider, as a final thought, how the sheer variety and detail of these provisions, often with very specific dates and definitions, really reflects just how complex modern legislation is and how it attempts to address so many different facets of policy and life.